Okay, we'll go ahead and get started. This is a Cash Cows update from Pacer ETFs. Joining me on the call this afternoon is the Senior Portfolio Manager for us here at Pacer ETFs, Michael Mack. A couple of housekeeping items. First and foremost, if you have questions as we're going through the webinar, you're all on mute at the moment. There is a chat box. You can type your question into the chat box, and then we will try to pay attention to those questions and answer as many of them as we're going along, or at the end, try to get as many of them as we can. You know, as we're all part of this giant group, some 150 million Americans now being forced to sort of shelter in place or work from home, we're struggling to interact on a regular basis, and one of the things we're trying to do here at Pacer ETFs is to do 2 digital lunch meetings a week on Tuesdays and Thursdays, one at 12 o'clock and one at 4 o'clock. 12 o'clock being for mostly the East Coast guys, and 4 o'clock for most of the West Coast folks. And we're rotating our content as we're doing this as well. So today's call will be on our Cash Cows series. I'll just start by showing you the complete list of the cows, our herd, if you will. COWZ is a large cap U.S. version. It uses the Russell 1000 as its screening group. GCOW is a global version of it, which uses a FTSE developed large cap index. ICOW is pure international. CAF, keeping with the theme of cows, is our small cow, so that's our little small cap CAF. ECOW is emerging market. Bull is the growth version of the Cash Cows, and then Herd is a fund of funds that owns a bunch of the cows. So a whole bunch of cows in one place is a herd, and so those are the tickers. We're not going to go through every ticker today on the call. What we're going to do is just highlight a couple. We'll start with the U.S. Cash Cows, ticker COWZ. Right now, when you look at the U.S. Cash Cows versus the Russell 1000 and you look at PEs, the Russell 1000 is now currently at 13 times earnings, and cows is trading at about 8 times earnings. And when you look at the far right slide there, U.S. Cash Cows versus the Russell in terms of free cash flow yield, about 2.5 times the free cash flow yield of the overall market. And when we're in this period of time where nobody really does know what's going to happen or what the long-lasting effects are going to be coming out of this bear market cycle, and once we're all sort of allowed to go back to work, what the economy is going to look like, or corporate earnings are going to look like, and who the winners and the losers are going to be, we're sort of partial to the idea of trying to identify high-quality companies that generate a lot of free cash flow, that have a high free cash flow yield. And we're able to do that today with the U.S. Cash Cows. We have 100 stocks in the U.S. Cash Cows index, and here's their characteristics as they sit today. So, 8 times earnings and about 10.9, almost 11% free cash flow yield. When you look at the charts, what you'll see is that 8 times earnings is probably as low as the PE has ever gotten on cows. You'd have to go back to 2008. To be able to pick up a lower PE. And coming out of that 2007 to 2009 cycle, the U.S. Cash Cows index was up 72% once things sort of got settled down and the market started to move forward. And when you look at the free cash flow yield, we're pretty high above what our normal levels are. There's only been 2 other times where the free cash flow yield was higher. That was in 2008 in that financial crisis bear market, and 2001 or 2 when we went through the tech bubble. So the next slide we have, is the rebalancing effect that we use in the cows, and I'll share the methodology with you in a minute. But what you'll see is that when you look at that sort of blue and orange line, that's our PE on the cows index, and the gray line is the PE on the Russell 1000 itself. And so again, you can see we're at a pretty deep discount to that current PE there. That comes in part from the rebalance. But what we also like to share this slide, the reason we like to share this slide is that when you're screening for something in particular and you think it adds value over time, you have to be able to sort of isolate the metric you're looking at. And so what this shows us is that, going back all the way to 2008, the PE on the cows was like 10 to 11 times earnings, and it's basically sitting slightly below that. And the PE on the Russell 1000 was like 12 times earnings, and now it's at 17. So, that's about a 40% increase in PEs over this 10-year period, which means that 40% of your return is coming from nothing more than stocks getting more expensive. And so what we like about this chart is it shows us that we're not paying more for stocks over time. We're basically paying the same price for the amount of earnings that we're buying. And when you look at what would happen according to FTSE Russell if you use the cows methodology on the Russell 1000, screening it down to the 100 companies with the highest free cash flow yield, you actually picked up a little bit better total return over that period of time. Mac, you have a comment on this slide that you'd like to make?
Yeah, the thing that stands out is just we're near the, recessionary lows of 2008. And so, we don't get these levels very often. So when they do, it's a pretty good opportunity.
And then when you compare like how cheap we are relative to our historical averages, when you look at the cows PE versus the overall market, we usually trade at a discount to the market, about a 32% discount on PE. Right now we're trading at 52% discount to the overall PE on the market. And like you said, you just don't get these opportunities very often to buy at these levels. You'd have to go all the way back to the tech bubble busting in 1999 to get a lower relative PE discount versus the broad market. And we're actually also trading in a very attractive range relative to value in general. Typically, we trade at a 22% discount to value. That's that dotted orange line on this chart. And right now we're sitting at about 38% discount to so we're actually getting to buy stocks here at a very low price on two metrics, really overall, just because the market's come down so much, but also on a relative basis when you look at PEs overall versus the market and then versus our benchmark, which is large cap U.S. value. Okay, so I'm going to pause here for a second. I've got a question. It says, how accurate are the estimates for free cash flow when it's backwards looking, or is there some component of forward-looking metrics that you take into consideration? I'll let you handle that one, Mac. I know the answer, but...
Yeah, so when we funnel this down, so our initial screen is to take the Russell 1000, exclude financials, and then screen for the highest trailing 12-month free cash flow yield. But before that screen is applied, we actually have another measure designed for this exact question, and it looks at the average consensus analyst estimates over the next 2 years, and then if it's looking at both earnings and free cash flow yield. And if any company is projected on average over the next 2 years by the analysts, if they're projected to have negative earnings or free cash flow, they're excluded off the bat. And so that's been a useful indicator, particularly in the case of, like, in 2014, we saw it come into play with the oil services companies where they had a bunch of contracts that were still booked out, and even though oil prices collapsed, they were still making decline revenues. But then the analysts knew where oil prices were, that earnings were going to be in trouble going forward, and so that kept those names from screening in. So it's not we're not basing our screen off that, but we're using it as kind of an extra kind of sanity check to make sure we're not buying stocks that are kind of about to fall off a cliff.
It's what we build into the methodology to avoid with the traditional value traps. Companies that are cheap but don't have any forward-looking earnings, and that doesn't mean they're going to they're going to go up in value, particularly if they're projected to lose money. So we're well aware of what a value trap can do in a value strategy, and so that forward-looking screen is what we use when we do the screen. So you want to talk a little bit about this one? Basically what we've got on the chart are quintiles, basically the lowest quintile to the highest quintile. We're sitting right now in that fourth quintile, so the second from the right. And so what you're seeing on this chart is our current, what we expect our current forward 3-year returns would be based on the spread we're making over what the overall Russell 1000's free cash flow yield is. Right now, that spread's about 618 basis, or the differential in return is about 618 basis points. So you wind up when you move up this scale, which means you're basically getting a big differential in terms of the free cash flow yield on the overall index, you wind up with outsized returns going forward from this chart, or from this point in the chart. You want to add a few comments on that, Mac?
Yeah. This is just tying to the point of really the best time in investing in general is when why do low PEs matter? Why do high free cash flow yields matter? And it's because where you start ultimately determines where you're headed. And when you're able to buy stocks at a discount like right now, it bodes very well for future returns. So when PEs and free cash flow yields are higher in this case, returns are also higher going forward, both on an absolute and a relative basis. So it's that's why right now it's setting up very favorably going forward, given that spread between what the Cow's index has and what the market is. So you're getting a 7 to 8% pickup in free cash flow yield based on this strategy, and that tends to be a good sign for the future.
And I know we haven't discussed this yet, but let's talk about free cash flow yield just for those that don't know. Free cash flow yield is the free cash flow a company's generating divided by its enterprise value. And enterprise value is market cap plus debt minus the cash on the company's balance sheet. And so when you think about where we are today in the cycle, and you think, we all hope it's going to be a really sharp V-shaped recovery. But the longer that this virus persists and the more we keep the economy shut down, there's going to be more carnage, if you will, in the overall market. And so, identifying companies who have a very high free cash flow relative to what it really costs to buy the whole company, right? And the whole company is the market cap plus the debt. If I was going to buy a company, I'd pay them for their stock and I'd assume their debt. And so what we think is we're putting a really strong portfolio out here today of high-quality companies that would be less susceptible to some of the prolonged negative effects that this market might cause. The weaker companies are the ones that are going to struggle, and they're either going to have to borrow a whole bunch more money to stay alive, or they're going to have to issue new stock to raise capital to survive. These companies are companies that are, although they're not thriving from a return perspective today, they're high-quality companies with strong balance sheets that have free cash flow, and then are paying very, very attractive dividends currently. And I don't know that we've covered the dividend thing yet, did we? Oh, yeah, we did. We covered it earlier. So this is how the screen works. We start with the Russell 1000, which is about 1,000 stocks. I say about 1,000 because none of the index numbers actually equal it exactly. There's always a few more or a few less. When you looked at the last time we did this, which was as of the last rebalance in December, you had about a 3.34% free cash flow yield on the overall Russell 1000. It was trading at that time at 23 times earnings, and you had a dividend growth rate over 3 years of about 9.4. As Max said earlier, we do the forward-looking screen and eliminate all those names that have projected negative earnings or revenues going forward, and we take out the financials. And that leaves us with 100 stocks. Those 100 stocks would have had a free cash flow yield of 7.47 and a PE ratio of 15.2, and a 3-year dividend growth rate that's just slightly better than the overall market. And then what we do is we don't weight these companies by market cap. We weight them by the free cash flow that they're generating. So we're wanting to put the bigger weights in the companies that have the higher free cash flows. And we cap all the names at 2% because we don't want to overexpose ourselves to any particular name. When you do that, you wind up with that square box in this funnel. That's the end result. So you have a free cash flow yield of 8.17, a PE ratio of 12.8, and a forward 3-year dividend growth rate of about 9.95%. So what FTSE Russell tells us, there's a lot of stuff on this. The first thing I want to look at is just the middle box that's got the green, the yellow, and the blue shaded columns in it. That middle box tells us, what we do is we go to FTSE and we say, here's our rules, and we're going to apply it to your index, and we'd like you to calculate it for us. And so they tell us that if you apply the rules going back to 1991, that using the cash cows methodology would have produced about a 15.6% compounded return versus the Russell 1000 at about 9.8, and a Russell 1000 value index at about 10. So you can see the slight value premium everybody talks about in the market, which we're all trying to exploit, but you have a big uplift in the total return. And when you look at the volatility, you're not increasing your volatility. You're getting a slightly better upside capture than the overall market, and versus value as well, and you're getting a better downside capture than the market and slightly more downside capture to the Russell 1000. And as I mentioned earlier, in the bottom of this page in that green and yellow and blue shaded columns, there's your best one-year return. The best one-year return for cows took place right after, the market settled at its bottom in 2009. It was up 72% versus 37 for the Russell and 38 for the Russell 1000 value. A couple of other things that are important when you look at the dividends that get created in terms of dollars. Going back to 1991, you would start with, starting with the Russell 1000, you'd have $100. If you started in the Russell 1000, you'd have about $5.96 worth of dividend income versus about $35.74 worth of dividend income using the cow strategy. Did I miss anything important on this slide, Mac?
No, I think you covered it.
Okay. And then we want to look at what we think is the real big opportunity here. The big opportunity here is that as we all struggle to fill up our large cap value box, it tends to be the biggest box on Morningstar that every portfolio we look at has a weighting to. And we usually are dealing with FAs that have 2 or 3 or 4 different large cap U.S. value strategies that they're trying to implement for diversification purposes. What's fascinating about the way the cow strategy works is that it is completely, not completely, but it is significantly different than the overall Russell 1000 value. So when you look at the sector weightings, for example, the first thing that I want you to note is that we don't have any exposure to financials in the strategy. That's usually where the biggest weight in a value portfolio is going to be. In this market, at this point in time, to me, it seems a little bit we'd be a little worried about overweighting the financials. We just saw a lot of the big European banks cut their dividends, and I was watching one of the financial news networks earlier today, and that was a big topic of discussion as well, is are the financials going to have to cut their dividends? And when they cut their dividends, obviously I don't think that's going to be great for their stocks. So, zero weight to financials. On the top of the chart, we have a big overweight to infotech versus the Russell 1000. And a big overweight to healthcare versus the Russell 1000, and a big overweight in industrials and communication services as well. So what you're looking at is a portfolio that from its characteristic standpoint looks very much like a value strategy, but it owns different sectors and different weights. And so it is really by adding U.S. cash cows to your large cap value sleeve, you're actually adding a second value strategy where you really are getting diversification. And in the infotech sector, most of that weight is in the chip makers, and they have traditionally always screened well, at least during the last several years, into this portfolio. So you want to talk a little bit about that, Mac?
Yeah, this is really one of the advantages of screening for free cash flow yield is you're looking at it from a different angle. And so a lot of in the indexing space, a lot of the value indexes look at the top of the income statement. So they're looking at things like sales, or they're focusing on like book value. But there isn't as much emphasis on earnings or free cash flow. And so really what you're trying to do here is complement your existing value strategies by adding a component that looks at the bottom line. And that's why the output's so different. So technology, they don't have a lot of plant, PPE, right? They don't have a lot of plant and equipment. It's mostly intellectual property. And so it's not showing up on their balance sheets or their book values. And so to a lot of funds, they're not considered to be value. But if you look at their profitability and their actual cash flows, you see they're generating boatloads of cash. And so we would say if you're trying to invest in a value strategy, you definitely want to own those technology companies. And so it's just the benefit of looking at your value from a different perspective that can really complement the other strategies.
Good. So the rebalance, continue to balance between defensive and cyclicals. We just went through that rebalance, strong balance sheets for cyclical stocks. Maybe a controversial name. We're going to talk a little bit more about it, but Southwest Airlines screens in. They're an interesting story in that they're not like a mega airline and they're not an international airline. They're primarily a U.S.-based airline. But of all the airlines, they probably have the best balance sheet in the business. They get more cash on their balance sheet than they do debt. And then diversified energy exposure. We're not really picking up the drillers here. What we're really picking up is a tech name inside the energy sector, which is Schlumberger. PBF is a refining company. They're actually near and dear to our hearts here in Philadelphia because they're based here. And so they benefit from lower oil prices. And then we've got a natural gas producer in the portfolio as well. Higher the potential advantages to using the cows is higher free cash flow yield and lower PEs, high dividend backed by free cash flow to support those dividend payouts. Free cash flow is dry powder for acquisitions or stock buybacks. I wouldn't think there'd be a lot of the names in the portfolio that would be going to the government to get bailed out, and so these names actually could continue to buy back stock potentially and protect against dilution. There's going to be a couple of ways people sort of rebuild their companies as we go through this. One is going to be by some of the stimulus money that's been put out there, but there's going to be a lot of companies, I think, that will wind up having to issue new shares in order to raise capital to stay alive. And we don't think that's going to be something that's going to affect the 100 stocks in our portfolio. And it's rebalanced on a quarterly basis. And the beauty of doing this in an ETF wrapper is that the rebalances can be made without capital gains distributions. And then one last slide, I guess, on relative value. When you look at the current cash cows index versus the Russell 1000 value, the dividend yields, we're about 60 basis points higher on current dividend yield. That's only happened a couple of other times, again, going back to that late 90s cycle. And then we got pretty close to them in that 2008, 2009 phase. But you're picking up a really attractive dividend versus traditional fixed income right now while you're owning a portfolio of high-quality companies that generate a lot of free cash flow. And we're not paying an awful lot for these companies for the free cash flow they generate. So this is the result of the last screen we did, which was just at the end of March. In order to make it into the portfolio out of the Russell 1000, you had to have a 6.85 or better free cash flow yield. When you look at the free cash flow names that we added to the portfolios, they've increased their free cash flow by almost 25%, but their stock prices were much cheaper. The median price change was down 23%, and the names that we took out were showing a decrease in their free cash flow. And we weren't getting much of a discount yet for that decrease in free cash flow. When you look at the before and after, free cash flow yield went from 11.2 to 12.2. The dividend yield went up to 395. PE ratio went down a little bit. And then our PE using the first quarter estimates is 7.4 times. Any more color on this chart, Mac?
No. I mean, once again, we're waiting to see analysts come out with their forecast for the earnings coming up. There hasn't been a lot of changes, so we know the free cash flows are going to change. But it is important to kind of look at the best indicate as we look through to the future, right? And start to look at 2021 and 22 for the long-term values. Really, the best estimate we have to go off of is what's happened recently. And so you see here the fact that they're growing versus backing into the index it bodes well for the future once this settles down.
All right, and then our current, after the rebalance, weighting is still pretty high in Infotech, although a little bit lower than it was in the first quarter. Basically the same weight to healthcare, slight increase in industrials, slight materials increase, a little bit of a consumer discretionary. Communication services went down a little bit, a slight pickup in energy, and consumer staples picked up about 230 basis points. So that's where we stand. And in healthcare, our top sub-industry is biotech. We decreased communication services. AT&T, CenturyLink, and Electronic Arts came out of the portfolio. And the slight decrease in the Infotech is essentially Micron and Lam Research both moving out of the portfolio. And we own we own 5 airlines in the portfolio, Southwest being the biggest of those as far as weight's concerned. So here's your top 10: Gilead, Cisco, Allergan, McKesson, Biogen, International Paper, Dell Computers, Altria, Qualcomm, and Cummins. That's our current top 10 holdings. You want to talk about Qualcomm a little bit?
Yeah, so Qualcomm is it's a great story in that they've designed they have a patent as far as how the chips are made in cell phones, and so what that means is if you're Apple or Samsung and you want to use their design, which is the best in the industry, you need to pay them a royalty fee. And so pretty much every smartphone that's created out there pays a royalty fee to Qualcomm. So they're almost like collecting a toll on the smartphone market. And as we look at the 5G upgrade cycle, they're well positioned to once again be the leader in the 5G patents. And so the growth projections are pretty good. And so getting 9.5% free cash flow yield, or a little under 9.5, and a 4% dividend yield is pretty compelling given the long-term growth of the strategy.
And 10% dividend growth the past 3 years as well. So, and then Take-Two, you want to talk about them? As we're all huddled up in our houses, this is the quarantine play, right?
That's it. I mean, we're getting ready to go into an upgrade cycle in general with the Xbox and the PS and the PlayStation, and then you have all these. I mean, about every school in America is close to closing if it hasn't already. So, video games is a great play on the current environment.
And then once we get back to normal, they're a leader on the esports side as well. So, and again, a nice healthy free cash flow yield. We're getting 8.2% free cash flow yield, which means on a relative value basis, we're buying the company pretty cheap versus the cash we're generating. Gilead.
Gilead, yes. So they've been involved in. They have a couple kind of antiviral therapies and so forth that have been used to help treat patients with this with the coronavirus. The main takeaway with Gilead, I thought the best kind of summarization of what's going on is whatever they do, if they're able to come up with a vaccine or if their treatments get more widespread use, that's not really going to affect the bottom line as much as the fact that people are now going to kind of realize for the years leading up to this, these biotech companies really weren't considered, the public sentiment towards them had really turned negative. And if you look right now with their treatments being helpful in this, the goodwill overall is probably going to, the greater effect on their business is people kind of coming to appreciate here is why we do need the Gileads of the world, and they really do create value in our economy. And so healthcare is right now actually traded at a much bigger discount, than it normally does, just again due to the negative sentiment. And so for them to be able to be helpful in this time should bode well for the company going forward.
Right, and you got a biotech name that's generating almost a 9% free cash flow yield and is paying a 3.47% dividend today. And they've been growing their dividend, but 9% year over year for the last 3 years. Southwest is our little airline in here. I said a little earlier about it. When you look at, they got $4 billion in cash and only $3.9 billion in long-term debt. They generate about 15.25% free cash flow yield. That may be affected by what's going on currently, but you have a really healthy margin there for them to weather and to be able to weather this storm in terms of their day-to-day operations. And then Schlumberger is an energy name, really, but we all talk about it here at Pacer like it's a technology name, right, Mac?
That's right. Yeah. I mean, the most exciting thing here is, one of the themes we're aware of here at Pacer is the power of big data and how so much of the future growth in the economy is going to be harnessing big data to take advantage of all the information that we have. And if you think about oil wells, you don't think of technology and energy, but you want to talk about a place for big data to take the lead over the next 20 years, it's going to be in energy. So it's right now that, there's so much data at these wells that they're not able to process, right? It's no longer the days of just drilling in a hole in the ground and oil shooting out. It's much more sophisticated, and then having all that data that tells you which wells are the most productive, especially in a low oil price environment right now, you're not going to cancel your contracts with Schlumberger because you need to make sure squeezing every last drop of oil out of your well in order to, maintain as much revenues as you can. So,
and again, 9.85% free cash flow yield. So, basically we're paying 10 times the current free cash flow for the company, and a 13.6% dividend, which, I guess that's a pretty hefty dividend, but it certainly has enough free cash flow yield to continue to support it. And then we're going to transition into small cap here. The small cap ticker CALF, CALF. We use the S&P 600 as our universe to start with. Prior to the rebalance at the end of last year, the free cash flow yield on the S&P 600 was 2.5%. PEs were at 18 times, and dividend growth rate was 2.5%. If you run the screen and exclude all the forward-looking negative earnings and revenue companies, you wind up with 100 names that have an 8.7% free cash flow yield, a 15.6% PE ratio, and a much higher dividend growth rate. And then by weighting them by their free cash flow, you wind up with a portfolio of 100 small cap stocks that have a 9.9% free cash flow, a current PE of 12 times, and a 3-year dividend growth rate of about 3.91%. And we use S&P for this one, so we basically give them our rules and say, can you guys tell us what this looks like versus the S&P 600? So we have a green shaded column and an orange shaded column. S&P tells us we should pick up excess return versus the benchmark. We should have a better upside capture at 109% and a slightly better downside capture. And when you look at the best calendar years and the worst calendar years, the best calendar year is better than the best calendar year for the S&P 600, and the worst calendar year is also better on the downside. So, and there's some remarkable things in here about small cap valuations. So these two charts here, the one on the left is the U.S. small cap cash house current index PE ratio as of the end of the last rebalance, March 31st. Small cap stocks, the 100 small cap stocks we own are trading at 7 times earnings. And the only time they were cheaper than that, again, would be going back to the middle of 2008, 2009. So again, the market certainly could go back and retest its bottoms and be more difficult going forward from here. But if you wanted to pick an entry point for a high-quality small cap strategy, you're not paying very much on a PE basis to buy the names that we are buying here. And rather than owning 600 stocks where we don't even know what most of them do, at least you're owning 100 stocks here that generate a lot of free cash flow relative to what their current stock price and debt added together is worth. And when you look at the the free cash flow yield, you're talking about 13.95% free cash flow yield. So our historical average on both those previous things, the orange line, so about a 50% discount on the current PE, and then the historical free cash flow yield has been around 12%. We're almost 14%, so you're picking up about a 15% premium to your typical free cash flow yield on small caps. And then this one just stuns me. This is the current dividend yield on small caps. It's 2%. And in this low interest rate environment, it's never been that high before since S&P has been helping us calculate this index. Typically, small cap stocks are going to yield around 1%. So you're getting double the yield to buy stocks at 50% of their traditional valuations. And to get into the portfolio, you had to have an 8.4% free cash flow yield. The additions to the portfolio saw a change in their free cash flow of about 36%. The deletions were names whose free cash flow yield was going down, and the median price we paid for those stocks is 38% cheaper versus 24% for the names that we let go. And then the before and after numbers are pretty stunning as well. Current free cash flow yield after the rebalance, 16.5. Dividend yield is 275 now. PE ratio is 6%, and the PE using first quarter estimate is 6.5 times earnings. Any comments on that, Mac?
Yeah, the one thing here is, and we'll see it in some of the names coming up, this is a little bit frustrating for some of these small cap companies because a lot of them are really starting to get momentum. And I think you see that there if you're looking at the companies that were added to the index, but on average, the companies that screened in were growing their free cash flow 36%. And so really what's going on right now is really masking what was, some emerging strength in some of these companies, and that these numbers right here kind of bear that out.
So just to pause and just to say, if you have questions, the Q&A box, the chat box is available to you, and we will certainly make sure we answer them. But here's the before and after sector allocations. So a slight increase to consumer discretionary, a slight increase to industrials, a slight decrease in infotech, a big increase in materials, a slight underweight to healthcare, consumer staples about half the weight there. Energy is a little bit of an overweight, so that's where we sit today. And then here's our top 10 holdings. So Sanmina, Trinseo, Contour, Asbury Automotive, Chico's, Warrior, Metallurgical Coal, Korn Ferry, Arcosa, Power Integrations, and Innoviva. So
hey, just wanted to add one thing to address that. The kind of elephant in the room with the small cap is, you know, the 26% in consumer discretionary. And I think it's helpful to kind of look underneath and kind of realize that it's not just, you know, small cap retail that, like, you know, we think is all going out. There's one of the names is like Sleep Number Bed. They make adjustable beds. That's actually a premium product, right? And, you know, as we look through a year from now, you're going to continue to buy beds, especially something like that, higher quality. Another name in the top 10 that I'm going to butcher the name, Contour Brands. They own Wrangler and Lee. So again, it's Wrangler jeans aren't going anywhere. And then, you know, you got some sporting goods companies in there and so forth. So there are parts of consumer discretionary that still work in an e-commerce world. And that's what we see here. And it's important to point out that in order to screen into this index, you still have to have the free cash flow. And the profitability itself tends to be a signal of quality. And then the other part is just the industrial. That's the other large component. And that's kind of the workhorse behind the small cap strategy. And kind of what's unique is there's a lot of niche, what you call mission critical businesses. And so to give you an example, Sanmina, they're a contract manufacturer. So if you think about things like cell phones, your laptop, you know, HP doesn't make my computer most often. They usually just design the parts and design it, and then they send all the components to someone called a contract manufacturer, and they actually build the machine out. And so they're, you know, if you think about that, they also do medical equipment. And the reason they're able to have free cash flow is because they have strong pricing power. Because if you think of where they are in the supply chain and what they do, their component is viewed as mission critical. And so that's important in the case of like medical equipment. I can't afford to get cheap with my suppliers at the risk of sacrificing quality. So I want my suppliers to do well in order to maintain the quality of my product. And so that's what a lot of these industrial companies are doing, is they're taking advantage of their little niche, and they're able to have strong pricing power. And the free cash flow really is a reflection of that. And so that's kind of the advantage of screening for free cash flow, is indirectly, you know, in order to have free cash flow, you have to have a strong business. So.
Yep. Good. Here's the whole lineup again. Cows is large cap, CAF is small cap, US, iCows International, GCow is global. Bull is our growth strategy in the cows, eCows emerging markets, and Herd is fund of funds. And then the 800 number right here on this page, 877-337-0500, if you want to get any more information from us on the strategies. Our wholesalers are doing the best they can to not bother FAs during this time frame too terribly, just reaching out to make sure everybody's okay. We have tremendous empathy for the job you're doing right now. You got to hit twice. One is that you're going through what everybody else is going through, and all of the, you know, uncertainty about being forced to sort of shelter at home and work remotely. And then on top of all of that, you know, we all chose a profession or a calling where we're helping people with their investment dollars, and the havoc that that's having on portfolios puts you folks under double pressure. So we understand that. And so we're here for you if you want anything. You know, we'll be reaching out. All our wholesalers now are equipped with their own conference call lines and their own Zoom or WebEx capabilities, so that during this period where we can't visit face-to-face, we're trying to get as close to you as we can. And and continue to support the FAs that are using our products, and we really appreciate that. So what I'm going to do is ask one more time if anybody has any further questions on any of the cows. And I didn't mention G-Cow's yield. Is that north of 7 now, Mac?
It is. Let's see. The free cash flow yield is 8, and the dividend yield is 8% as well.
8% dividend rate on global cash cows.
That's right.
Wow. We were feeling pretty good when it was 4%.
I know.
For those that have the stomach to, put the money in now and say, I'm going to buy for the next 3 to 5 years and hold on, and it could get worse before it gets better. We all know it's going to get better. There's an old Nick Murray line about the market, and the only 8 words you need to know is the advance is permanent and all declines are temporary. And so this is a kind of an opportunistic way to kind of reposition portfolios into high-quality names that we know are profitable, generate free cash flow, pay competitive dividends, and are growing their dividends. And will be less, we think, a little less influenced by how long this shutdown really is because of the strong balance sheets and the free cash flow that they currently generate. So let's see if we have any questions. Oh, we do. Can I go back to the previous page? Will the slide deck be available? Yes, we will make sure we will get the slide deck out. I don't know when this came in, 12:40, so it's a minute ago. So the previous page, is this the page you're looking for? Or was it the holdings page for the top 10 names in CAF? Or was it another one? I guess it would have to be one of these last 3 or 4 pages. That's the sector weights on CAF. And then you have top 10 holdings. And then your complete lineup. So cows is large cap U.S., CAF is small cap, as I said, U.S., iCows International. Okay, thanks, Thomas. This is the page you wanted. G-Cow is global. Bull is the cash cows growth. That we use an S&P Pure Growth Index to screen out of that one. E-Cows emerging markets, and herd is the fund of funds. So just make sure we don't have any more questions here.
Sean, there is another one on relative performance. Yeah. So relating to cows and calf. And I think it's a good question because what's happened in the last, the question says since 2018, what's happened is you've seen both cows and calf lag the broad indexes. And what's going on is this can happen. It's a normal kind of phenomenon late in cycles. We saw this happen in the late 90s as well, where if you think about the dynamics at the end of a bull market, it's easy to lose sight of free cash flow because most companies are now turning to profitability. And then if you think about, credit, right? Credit's cheap and easy to get. And so when that happens, the market oftentimes kind of just ignores the free cash flow ability of a company and then focuses more on the growth prospects. And so that's what we've seen at the end of this bull market as well. And so that caused the cow strategies to lag. The good news is the earnings have continued to grow over this time. It's just during the last year and a half, the price was lagging the earnings. So it was, again, kind of sentiment driven. If you take 2008, so we actually think the underperformance recently is actually a good thing going forward. And I think we saw that play out in the chart at the beginning where it shows, how did we get to these record low valuations and what's it mean for future performance. But if you use 2008 as your guide, leading into 2008, 2007, it underperformed because the market, again, was ignoring the free cash flow of these companies. And then the crisis hit. And during the crisis, the correlations go to 1 and everything everything moves in tandem. And so you almost track 1 for 1 during the crisis. But then what happens is as you get through and towards the later end of the crisis, right, and then the market starts to get visibility, what you see is the market starts to look through at a company's earnings and say, okay, look at these companies who had been generating free cash flow that have strong balance sheets. Let's rotate into them. And so a lot of times they go from laggards to performing in line to leaders as we get to the end of a decline in the market. And so the timing right now is setting up pretty favorably as we go forward.
So we don't have any more questions. Again, thanks for being on. Again, everybody, hope your families are safe and sound. And you're enjoying some time together. That's the good. I guess that's the silver lining in this cloud of what's going on with the markets and us having to all work from remote locations, is we're getting to get reconnected with our families. And so, and if we can help you all at all in any way, again, the 800 numbers, it's 877-337-0500. And if you want the slides, because there was a request for that, if you'll just get in touch with us, we'll make sure we get the slides out to you. So everybody have a great day. Thanks for being on with us today. It was great talking to you.